When it comes to the economy itself, I think we're still in Goldilocks territory. Inflation is really subdued. In fact, we've seen a little tick down in the last month on the PCE deflator, for example, the Fed's favorite measure, and on average hourly earnings, which went down slightly. Earnings growth continued to be strong. We saw that this morning with Goldman Sachs and the banks as a whole. Our Evercore ISI company surveys, which we've been doing for many, many years and pay a lot of attention to, show that business is solid, but not at peak levels. And so I think the economy itself is really solid. Now, the yield curve also underscores that because the yield curve has steepened, putting to rest, at least for the moment, all the fears that an inverted yield curve would signal an imminent slowdown. And the 10-year yield to maturity, we all know, has come down a bit. Not a lot, but about 10 basis points in the last few days. All of those are positive signs for the underlying economy. Markets, we all know, figuring out the timing of markets is pretty impossible, or at least it is for me. I agree with Larry's characterization of the feeling among market participants, but I tend to focus more on the underlying economy, and I think it's still, as I said, very solid.
We've seen some industrial companies at least hit some headwinds, in part because of the continuing tensions with China. And the concern overall, I think, among some investors is that while dollar amount wise it may not seem that large a number, it throws sand in the gears. That is the increasing tension between our country and China in a lot of different business opportunities and therefore economic growth worldwide. Do you agree?
Yes. I mean, what are the risks here from a big picture point of view? One is geopolitical, geofinancial, in particular Turkey, Argentina, and so forth. A second, I think, is the trade war with China. Markets have been looking through that now for months, but if we had had a discussion here a year ago or 2 years ago or 3 years ago, and we said, hey, if the U.S. gets into a real trade war with China, what do you think the market reaction would be? And I think we all would say to ourselves, it'd be bad. And the third risk, by the way, I think, is the U.S. fiscal outlook. We just saw the deficit was $800 billion for the last fiscal year, ended last month. It's going to be $1 trillion this year. At some point, it might take 2 or 3 years, markets will wake up, look at that, and they won't like it. So the trade war ought to be, in theory, a real negative. Markets haven't interpreted it that way or embraced it that way. But again, it's one of the risks in terms of market sentiment and ultimately market direction.
But those two things you mentioned specifically, the trade war and the deficit, do they keep the Fed from pausing or recomputing the way some of the equity bulls hope?
I don't think so, but I don't think the Fed path is going to deter the equity markets. I mean, if you look back, and my colleague Ed Hyman published something on this yesterday, in the 2004-2007 period, the Fed, I think, hiked 30 times or something like that and got ultimately to 5.25, and markets were strengthening throughout that entire period. Now, it's not exactly the same as today for obvious reasons, but I don't think the Fed path, which I think is very much accepted by the markets, has been for a long time, is going to be the thing that turns the markets negative.
Though there is this question about whether, and this gets to your Goldilocks theory and also to your M&A business, which is money still cheap?
The answer is yes. I mean, the 10 years at, what, 316 this morning? I mean, I've been doing this a very long time. I believe the 50-year average on the 10-year is 5 to 6%. So to see a 3% 10-year, and obviously that's the benchmark. And by the way, spreads, I mean, junk bond spreads, double B spreads and so forth are very tight. So if markets were concerned about the direction of the Fed or the direction of interest rates more generally, those spreads would be widening out, and they're not.